Trade slippage is a common occurrence among crypto newbies who have recently entered the world of cryptocurrencies. The term trade slippage refers to the situation in which investors are unable to trade cryptocurrency at the anticipated price. This video will explain what slippage is, how it works, the many forms of slippage, and provide some examples of slippage. It will also discuss ways to avoid slippage when investing. Before we start discussing in detail, please subscribe our channel and also press the bell icon as well. What is a slippage in crypto? Slippage occurs when traders acquire or sell their assets at a price that is either higher or lower than what was expected. Slippage can be seen in its most basic form as the gap between the expected price of a deal and its actual price. When it comes to purchasing and selling cryptocurrencies, this kind of thing happens pretty frequently. When you engage in trading, you do it with the intention of buying or selling at a predetermined price. However, due to the rapid nature of the cryptocurrency market, the price may shift between the time your order is placed in the market and the time the deal is finalized. As a result, you run the risk of purchasing or selling at a price that is either greater or lower than what you had planned. The discrepancy between the price you had in mind and the price you ultimately had to settle for is referred to as slippage. How does slipping work? The discrepancy between a targeted price and the actual price on the market is not the only component of the definition of slippage. Slippage can also be broken down into two categories: positive and negative, both of which can have a substantial impact on your trading techniques. Slippage is considered to be in the buyer's favor when the real price is lower than anticipated and, as a result, provides traders with a better buying rate. When the real price is greater than predicted, this is considered to be negative slippage because it provides traders with an unfavorable purchasing rate. For a sell order, slippage is positive when the actual price is greater than predicted, therefore allowing traders to benefit more on a sell. When the real price is lower than projected and results in losses for traders, this phenomenon is known as negative slippage. Slippage can occur in any market, including stocks, forex, and cryptocurrencies. However, due to the extreme volatility of the cryptocurrency asset class, it is a particular concern in this market. To put it another way, depending on the direction the market takes, slippage in crypto might represent either a significant gain or a significant loss for traders, depending on the state of the market. As you progress through your career as a cryptocurrency trader, you may also have become familiar with the term slippage tolerance. Trading platforms for cryptocurrencies typically give you the ability to choose the proportion of your order's transaction value that you consider to be an acceptable slippage cost for you to pay. Your tolerance for slippage is expressed as a percentage of this total. If the actual transaction's value is higher than the slippage tolerance that you specified, the trade will not be performed. You need to perform a computation of slippage and make a note of the cost of slippage in order to reduce the likelihood of experiencing negative slippage. When you are generating your market orders, it is helpful to take into mind the amount of permissible slippage. This can help you determine a better position in which to enter or exit the cryptocurrency market. Slippage examples. Trading slippage is an extremely important factor in your overall tactics. Imagine that you want to buy a cryptocurrency order at the price of US $20.0 that is displayed on the broker interface. You go ahead and place your order, but when it is complete, you find out that it was processed at a cost that is $20.50 more than what you were expecting to pay. Because you acquired an order at a greater price than you expected to, the overall buying power of your money has decreased as a result of this circumstance, which is an example of negative slippage. On the other hand, positive slippage occurs when you place a buy order at US $20.0 but finalize it at just US $19.50. This could happen if, for example, the price of an asset suddenly drops. Your purchasing power will increase as a result of the cheaper price. Because of this, as a trader, it is imperative that you are familiar with and have a good understanding of the concept of slippage. Slippage in PancakeSwap. PancakeSwap's tolerance for slippage is different from that of Uniswap and Trust Wallet, respectively. There is a possibility that the default percentage of slippage tolerance between platforms will fluctuate slightly. For example, the slippage tolerance of PancakeSwap is distinct from that of Uniswap and Trust Wallet. PancakeSwap slippage tolerance is lower. If you're curious about the concept of slippage in PancakeSwap, the default percentage ranges anywhere from 0.5% to 1%. There is no optimal slippage tolerance for PancakeSwap because it is contingent, at all times, on the trading strategy that you employ. However, if you know how to modify the slippage on PancakeSwap when you are creating your market order, you will be able to decide for yourself what your acceptable slippage level is. You can alter the amount of your allowable slippage while performing transactions by going into Settings and adjusting the slider. Slippage in Uniswap. The slippage percentage that is set at 0.5% by default in Uniswap is a number that you and your trading strategy may not find to be optimal. In a manner analogous to the manner in which you may make modifications to PancakeSwap slippage, you have the option in Uniswap to either lower or raise your tolerance for slippage. When you click the gear or settings icon in the top right corner of the browser, a little box will open where you may personally customize your slippage tolerance when trading. You can also pick the ideal slippage tolerance for Uniswap according to the trading method you use. How to avoid slippage? Because of the rapid fluctuation in price of the cryptocurrencies, it is not a given that you will be able to prevent slippage while trading in a volatile market such as crypto. However, there are certain things you can do to reduce the amount of money you lose due to slippage. Avoid trading during volatile markets. Significant events and statements involving the crypto market can affect price fluctuations dramatically and create slippage. A meeting of the Federal Reserve is a fantastic example of an important event since it can have an effect on the interest rate, which in turn can have an effect on the values of assets on the investment markets. If you can avoid trading during these events, you will be able to avoid slippage entirely or at least reduce its impact. Stay cautious during important announcements. Major announcements have a tendency to cause the market to be more volatile than usual. Before making a decision to invest during times like these, prospective investors should give themselves more consideration. For instance, project upgrade announcements such as Ethereum's The Merge, Bitcoin Cash's or Cardano's hard forks can have a significant impact on the price of the cryptocurrency. Invest in popular assets with high liquidity. Investing in well-known assets that have a high level of liquidity can help mitigate the risk of slippage to some extent. Investors should, as a general rule, avoid entering a market either before or after an organization has announced its financial statement. This is especially true for cryptocurrency. When it comes to the cryptocurrency market, investors that invest in foreign currency may prefer to concentrate on the currency pairs that have a large level of liquidity, such as EUR, USD or AUD, JPY, rather than the less prevalent ones, such as TRY, ZAR. Bottom line, slippage is a phenomenon that frequently occurs in the cryptocurrency trading industry. It occurs whenever the current market price does not match the price that you had intended to pay when engaging in a transaction. It is not always a bad thing, despite the fact that it can affect your trading plan. Slippage can either be beneficial or detrimental for you, depending on the circumstances. It may result in a significant increase in profits or a significant decrease in profits. Cryptocurrency traders need to be aware of the possibility of slippages in their transactions at all times for this reason. Using a fast broker, putting in stop orders, and keeping up with the latest market news and trends are some of the ways you can reduce the amount of slippage in your trades. There are also other ways. Slippage is a strategy that seasoned traders employ to their advantage. They consistently devise a solid plan for buying and selling that allows them to maximize profits and minimize losses. You will be able to execute better trading strategies if you have a solid understanding of the concepts of slippage and slippage tolerance in the cryptocurrency market. So, that's it for today. Was this video helpful? Share your views in the comments section below. Also, don't forget to subscribe to our YouTube channel and press the bell icon for all the latest updates. Thanks for watching.